If you're buying this S&P 500 breakout, you're not catching a rally. You're being used as exit liquidity. In 1973, retail investors bought the exact same deceptive price action right before they was half their wealth. Right now, dealers are trapping late buyers. Cracks are forming in the credit markets, and the entire system is set up to punish the herd. In the next 5 minutes, I will show you the exact data print that proves this is a mirage and the exact indicator revealing when this trap collapsed shut. Look at 1973. After the oil embargo ceasefire, stocks initially rallied instead of collapsing overnight. The market took months to realize higher energy costs would decimate margins. Retail investors guessed that the worst was over, but the lagged effect was deadly. Once inflation ticked back up, the market fell into a brutal bear market. As a former hedge fund trader, I have seen this delayed response repeat often. We're in the exact same lag today. Oil refuses to fall below $80, yet the mainstream ignores this, hoping the Federal Reserve can engineer a soft landing. But energy is the fatal transmission mechanism. The 73 data proves that when an oil shock meets a late cycle breakout, you're not buying growth, you're buying the top of a structural illusion. Now look at the data they are trying to hide from you today. We are being told that the S&P 500 is breaking higher and it is time to allocate cash. I'm looking at the real volume beneath this breakout. Notice this index is pushing higher on completely exhausted volume. Paired with a massive divergence in the relative strength index, this is the signature of a ghost rally. But we need to dig into the plumbing. This is the recent producer price index report. While services inflation remained flat, goods inflation just saw its biggest increase since August 2023. This surge is driven explicitly by energy. And why are gasoline and crude not falling? Months ago on this channel, I warned you that silver was set to fall and equities were vulnerable, pointing directly to oil as the breakout trade to watch. All three of those scenarios played out exactly as mapped. This is what we do here. We spot the rotation before the crowd does. If you want the next play before it hits mainstream news, make sure you subscribe. US oil exports are surging. At the same time, record draws from the Strategic Petroleum Reserve have left US without a domestic buffer. Consumers are already feeling this pain. If we examine the University of Michigan consumer data, the real-world inflation pain metric is ticking sharply higher. The consumer is hitting a wall. Meanwhile, smart money and institutions are quietly heading for the exits. Let us walk away from the mega cap stocks and check the Russell 2000. The small caps are stalling horribly because they are sensitive to the real debt costs. Over in the distressed debt world, we are already observing severe cracks in the high-yield credit markets. When you combine cracking credit with option dealers rapidly flipping into a short gamma positioning, it means market makers can no longer suppress volatility. Instead of buying dips to hedge themselves, dealers will be forced to sell heavily into the initial weakness, ensuring that any downward shock is mechanically amplified. Finally, we have to address the elephant in the room. Look at the spread between the US 2-year and the Japanese 2-year yields. This spread is narrowing rapidly. This is very dangerous for stocks because it forces the unwinding of the yen carry trade, which drains massive offshore dollar liquidity from the high-risk equities market tethered to it. If you need more evidence of this trap, look at this explosion of call options volume concurrent with the breakout. Retail traders are piling into the upside bets at a historic rate right as liquidity is being drained and create cracks. This blind euphoria is the ultimate confirmation. The herd is maximizing leverage exactly when they should be preparing for an impact. Now, the Wall Street cheerleaders will argue that earnings are strong and that liquidity remains expansive. They will claim the Bank of America bull and bear indicator is only flashing a modest 6.3, proving we have not yet reached manic euphoria, but they're ignoring the tremors in the volatility regime. The VIX is ignoring the stock market and is forming aggressive higher walls. The institutional system is bracing for an impact, while retail investors provide the exact exit liquidity needed for large funds to unwind their positions. However, if oil drastically collapses back down to $60 a barrel, this entire thesis breaks. Without continued energy pressure, the inflationary input stress vanishes, granting the Federal Reserve maximum cover to inject fresh liquidity and float the tape even higher. But the physical commodities market suggests otherwise. The trap closes in late April. Historical seasonality for midterm election years exposes a higher volatility drop-off window for equities starting in the second half of this month. The thesis suggests that this historical anomaly will repeat. Watch for the VIX to break violently upward out of its ascending base. If we see sustained higher volatility alongside crude oil sticking firmly above $80 a barrel, the bottom will drop out of this artificial rally. Do not mistake their algorithmic markup for a genuine buy signal. See you in the next one.